Debt can make you rich when you use other people's money to control assets that actually grow in value and generate cash flow. You see, debt isn't always a bad thing. In fact, it can be your ticket to financial success. Think about businesses, for example. Many of them start by taking out loans to get the capital they need to kickstart their operations. Now, while the bank might own the right to the interest and payments on that debt, the business owner owns the business itself. And that business has the potential to generate profits and cash flow that can grow over time. But it's not just businesses that can benefit from this strategy. Even you can become a capitalist of sorts by using debt wisely. Rich individuals, for instance, leverage low-interest loans to multiply their returns on capital. They use debt to expand their control over assets, allowing their money to work for them in multiple ways. I like to think of it as having your cake and eating it too, where your assets are growing and your borrowed money is making you richer. So, if you ever wondered how the wealthy get wealthier, stick around because we're about to uncover 5 powerful ways they use debt to build their fortunes. Number 1. Leverage in real estate. Let's say you want to invest in real estate but only have $10,000 to spare. With that money, you can make a down payment on a $200,000 house. Now here's where the magic happens. That $10,000 can control the entire $200,000 property thanks to leverage. So, when the property's value increases, say by 20%, from $200,000 to $240,000, your $10,000 down payment suddenly turns into an incredible $40,000. That's a 300% return on your initial investment. See how debt allowed you to multiply your wealth? But wait, there's more. Debt can also be your ally in creating cash flow. You can use it to buy rental properties or Airbnb houses, generating monthly income. The beauty here is that your returns come from entire debt amounts, not just the money you put in. So you're leveraging your investment to create a steady cash stream. Number 2. Leveraged buyout. Ideally, this happens when the buyers of a company take a significant amount of debt as part of the purchase process. Picture this. A company is up for grabs and you want it, but you don't have all that cash up front. So what do? You borrow a substantial chunk of the purchase price. Now here's where the magic kicks in. The debt you take on is often secured by the assets of the company you're buying. After the asset is sealed, you become the big boss with a controlling interest in the target company. But what's the plan? Pay off that debt using the future cash flow generated by the company you now own. So, a leveraged buyout makes you see the potential in a company, and you're willing to take on debt now to secure a bright future. It's a bold financial strategy where debt becomes a tool for wealth creation, allowing you to grab hold of companies and watch your investments grow. Number 3. Short selling. Normally, you buy low and sell high in the stock market, right? Well, short selling flips the script. Here's how it works. You sell something you don't even own, like borrowing your buddy's skateboard and then selling it to someone else. But now you owe your buddy that skateboard back. Similarly, in the stock market, you borrow shares from your broker and sell them to another investor. But you've got to give those borrowed shares back someday. You pocket the cash from the sale, but it's not yours to keep. It's on loan. When you return the borrowed shares, you repurchase them in the open market. If the prices drop since you sold them, you've made a profit using debt. But here's the catch. While you're in a short position, you'll be paying some interest to your broker for borrowing these shares and maybe even dividends that were due. It's a high-risk, high-reward game in the stock market where you can make money whether stocks go up or down. Ideally, short sellers bet against the rise of stocks and potentially make a profit when the market takes a dip. It's a thrilling strategy that requires nerves of steel as you're banking on a stock's fall. But when the timing is right, you repurchase those shares for less than you sold them. If you don't mind, consider hitting the subscribe button. It really helps our channel grow. Number 4. Margin accounts. Let's say you have this friend who's willing to lend you some cash to make a bigger trade in the stock market. That's what a margin account is like. Now, why would you want this? Well, you can trade bigger positions and make your wins even more exciting. But, and there's always a but, it also means if you make a losing trade, it's gonna sting more. See, if you normally trade one share of a stock, with margin you can trade two. So if the stock goes up, you make double the profit. But if it goes down, you're looking at double the loss too. One cool thing about margin is that you don't have to wait for your trades to settle before making new ones. But remember, it can be a bit exhilarating, but you need to know what you're doing, or you might get injured. So margin accounts can be an amazing tool for savvy investors, but they do come with risks. Number 5. Using debt for living expenses. Now, picture this. You're sitting on a bunch of stocks, and you're not quite ready to sell them because you don't want to deal with those pesky taxes. But you've got bills to pay and a life to live. That's where using debt for living expenses comes into play. You can take out a loan against your stocks, also known as a margin loan, and use that money to cover your living costs without touching your precious stocks. Now here's the cool part. When you eventually pay back that loan by selling some of your stocks, you might not have to pay as much in taxes. For instance, if you sell a losing investment, you can offset the gains and reduce your overall tax bill. Plus, some types of income, like dividends or certain capital gains, get taxed at a lower rate than regular income. So not only are you keeping your investments intact, but you're also keeping more of your money in your pocket. This strategy isn't just for the super rich. Even regular investors can use it to their advantage. But like any financial move, it does require some know-how and planning to make sure you're doing it right. But wait, have you ever wondered how billionaires like Elon Musk seem to have endless cash at their disposal? Well, one of their secrets is being smart with debt. Let's take Elon for example. When he needs some extra cash to fund his endeavors or even his daily expenses, he doesn't just sell his Tesla shares and deal with hefty capital gains taxes. No. Elon uses his Tesla shares as collateral for loans, kind of like offering them as a guarantee to borrow money. This way, he can access massive amounts of cash without parting ways with his shares. Plus, because the loans are backed by his stocks, he doesn't have to pay those pesky capital gains taxes until he's ready. So instead of selling his assets, Elon leverages them to get the money he needs. It's a smart move that helps him build wealth while maintaining control over his investments. And while Elon is on another level as the richest man in the world, the idea of strategically using debt can also apply to you. So whether you're starting a business, investing in real estate, or exploring new financial horizons, remember that debt can be your ally in the journey to prosperity. But always tread carefully, seek expert advice when needed, and make sure you're using debt to create assets and cash flow that will supercharge your net worth. If you found this video insightful and want more tips for building wealth, don't forget to hit that subscribe button and ring the notification bell. We're here to help you on your path to financial freedom. Thanks for tuning in, and we'll catch you in the next one.